Aya Gold and Silver missed Q2 2026 consensus. They reported an EPS of 23 cents, which missed Wall Street estimates of 36 to 39 cents. Revenue came in at $96.8 million.
Right.
Now, that top line number is actually up 151% year over year, but, it still missed the street's $121 million forecast.
Yeah, quite a bit short.
Right. But despite this, full year 2026 guidance was firmly maintained. Management is still projecting 6.2 to 6.8 million silver equivalent ounces for the year, with unchanged cash cost targets.
Exactly.
The market reaction, though, was swift. The stock was just punished for the top and bottom line miss, dropping roughly 3.8% to close around $25.92.
I mean, it's a textbook market reaction to a headline miss. The algorithms, the momentum traders, they focus entirely on the immediate accrual accounting snapshot.
Oh, for sure.
They see the revenue and EPS miss, they hit sell, and they move on. But when you look past the immediate quarter-end cutoff dates, the underlying industrial machinery of the business is telling a very different story.
Okay, so let's unpack this. Because for you, the retail investor sitting down tonight to update your valuation spreadsheets, we have a glaring contradiction to resolve here.
We really do.
We are looking at a company that just posted an absolute blockbuster operational record, yet they suffered a massive financial miss on paper. So we need to look under the hood of Aya's Q2 report and figure out the mechanics of this miss.
Right, like what's actually happening on the ground.
Exactly. Is there a systemic flaw in their business model, or is this simply, a temporary accounting lag that creates a buying opportunity?
Well, when you decouple the physical mining of the metal from the financial reporting of the revenue, the picture changes entirely. Let's look at the physical reality on the ground in Morocco.
Okay.
Operationally, Q2 is staggering. Consolidated production reached 1.68 million silver equivalent ounces. That is a 61% increase year over year.
Wow.
Yeah, and operating cash flow surged 522% year over year to $48.4 million.
Whoa.
In the first half of the year alone, they generated $119 million in cash flow.
That's massive.
It is. The physical assets are just churning out massive amounts of metal and generating immense cash.
But wait, if they're pulling a record amount of silver out of the ground and operational cash flow is up over 500%, how on earth did they miss revenue estimates by over $24 million? Like, where did that value go?
It comes down to logistics and timing. Specifically, it's an inventory sales lag. In the mining industry, pulling rock out of the ground and milling it into concentrate is only step one.
Right.
Step two is getting that concentrate onto a ship or delivered to a smelter, finalizing the assay to confirm the exact metal content, and officially transferring ownership.
So the accounting side of it.
Exactly. Only then can you legally recognize the revenue on your income statement under standard accounting rules. In Q2, Aya mined and milled a record number of ounces, but a significant portion of those ounces were physically sitting in inventory, completely unsold, when the quarter closed at midnight on June 30th.
Okay, let me put this in a different context to make sure we are modeling this correctly for everyone.
Yeah.
It's like a bakery churning out a record number of cakes, right? The kitchen is humming, everything is great, but the delivery truck got stuck in traffic on the last day of the month. The cakes exist, the value is there, but the cash register hasn't run yet.
What's fascinating here is that is a perfect way to visualize it. The analysts who built that 121 million revenue forecast assumed a steady, linear sell-through of what was produced.
Right, they assumed every cake was sold immediately?
Yeah, they assumed every car rolled off the line and immediately onto a ship. But commodities logistics are inherently lumpy. You are dealing with bulk shipments, port scheduling, specialized transport. Aya had a massive buildup of physical silver concentrate that simply didn't cross the accounting finish line in time for the Q2 print.
So it's just sitting there waiting.
Yeah. And to make matters more complicated for the income statement, that timing issue was compounded by a sudden drop in the price of silver itself.
Oh, right. The realized price took a sequential hit right at the end of the quarter.
Yeah, even though the year-over-year realized price was up 90%, looking sequentially from Q1 to Q2 of 2026 tells a different story. The average net realized silver price dropped 22%.
Ouch.
It fell from $82.22 per ounce in Q1 down to $64.22 per ounce in Q2. So you essentially have a perfect storm for an earnings miss.
Right.
A large chunk of your record production is sitting in inventory unsold, and the ounces you did manage to sell and recognize were sold at a 22% lower price than the previous quarter.
Which explains the headline miss perfectly. The revenue isn't destroyed, it's just delayed.
Exactly.
So if the operations are actually performing that well, we really need to break down the specific assets driving these ounces. We need to understand the underlying unit economics to see if the core business is actually as healthy as that record production number implies.
Yeah, we have to look at the factory floor.
Right? If the cars are just sitting on the lot, what is happening at their flagship mine, Gounder?
Well, Zgounder is the absolute engine of this company. In Q2, it produced 1.49 million ounces of silver on its own.
That's huge.
But the most critical metric for investors to watch, the one that dictates future profitability, is the throughput. The newly expanded processing plant was originally engineered for a design capacity of 2,700 tons per day.
Right.
In Q2, they didn't just meet that capacity, they achieved an average milling rate of nearly 3,900 tons per day.
Wait, really? That is almost 45% above nameplate capacity.
It's incredible.
You rarely see a mining ramp-up hit its targets on time, let alone exceed design capacity that aggressively. How does a physical plant process 45% more rock than the engineers designed it to handle?
It usually comes down to a combination of over-engineered components and just exceptional operational execution.
Okay.
Often, mining companies will install primary crushers or ball mills that have a little extra give beyond their rated specs. If the mining team is delivering highly fragmented ore from the pit, meaning the rock is already blasted into smaller, more manageable pieces.
The mill doesn't have to work as hard.
Exactly. It doesn't have to work as hard to grind it down. Add in exceptionally high plant availability, where they aren't taking the plant offline for maintenance as often as budgeted, and suddenly a 2,700-ton plant is processing 3,900 tons.
And when you push that much more tonnage through fixed infrastructure, what does that do to the unit economics?
You get massive operational leverage. Think about the fixed costs. The grid power, the administrative staff, the baseline labor force, the site maintenance.
Do they stay the same?
Yeah, those costs remain relatively static, whether you process 2,000 tons or 4,000 tons. When you spread those fixed costs over a much larger denominator of processed tons, the margins explode.
Right.
The results in the Q2 report are striking. Production cost per ton processed plummeted 33% year-over-year to $55.61. And the cash cost per ounce of silver fell 17% year-over-year to $17.69.
So they are mining more efficiently, moving more dirt, and doing it significantly cheaper per unit.
Yeah.
That is the definition of operational health. But Zgounder isn't their only operation anymore. We have to talk about Boumadine, specifically the pyrite reclaim operation, which is acting as a completely new catalyst for cash flow.
Oh, the Boumadine reclaim is a brilliant, low-risk strategic move. They are taking a historical pyrite stockpile, which is essentially waste rock left over from past mining operations decades ago, and reprocessing it using modern techniques.
Smart.
In Q2, this reclaim operation produced roughly 187,000 silver equivalent ounces. That breaks down to over 100,000 actual ounces of silver and about 1,414 ounces of gold.
Wow, just from waste rock.
Yeah, it requires very little upfront capital. It has minimal cash costs because the rock is already out of the ground, and it actively cleans up the environmental footprint of the historical site, all while generating free cash flow to help fund the much larger future Boumadine development project.
But here's where it gets really interesting for anyone trying to model this company. Looking at the report, there is a very weird quirk in how the costs for Boumadine are presented.
Yes, there is.
Management noted that Boumadine's reported unit costs were negatively impacted by a compression in the gold to silver ratio.
Yeah.
Essentially, gold prices went up relative to silver.
Right.
If gold prices go up, why does that make their unit costs for Boumadine look worse on paper? How does that math make sense for a retail investor trying to model this?
I know. It is entirely counterintuitive, but it is a vital quirk of mining accounting that you have to understand to read these reports accurately.
Okay, lay it on us.
It all comes down to the concept of silver equivalent, or AID ounces. Because Boumadine produces both physical silver and physical gold, Aya has to find a way to report a single, consolidated production number to Wall Street.
Right.
They do this by mathematically converting the value of the gold into silver.
So you establish a ratio between the two metals based on market prices.
Precisely. When Aya issued their 2026 financial guidance, they budgeted their year using an 80-to-1 gold to silver ratio, meaning for every 1 ounce of gold they produced, they would multiply it by 80 and report it as 80 ounces of silver equivalent. However, in Q2, gold had a massive run and significantly outperformed silver in the market. The actual realized ratio compressed to 61-to-1.
So a single ounce of gold was only buying 61 ounces of silver instead of the 80 they planned for.
Exactly. So on paper, because gold was suddenly relatively more valuable, the actual physical gold they pulled out of the ground translated into fewer silver equivalent ounces. They had a smaller denominator in their accounting formula.
Great, that makes sense.
Let's say you spend $1,000 to operate the Boumediene reclaim for a day. If you divide that $1,000 by 80 silver equivalent ounces, your cost is $12.50 per ounce.
Okay.
But if you divide that same $1,000 by only 61 ounces, your cost jumps to $16.39 per ounce. Your actual expenses didn't increase by a single penny, but your cost per ounce artificially inflates.
That is wild.
Yeah, management explicitly noted that if the ratio had stayed at their budgeted 80-1, they would have reported roughly 26,000 more silver equivalent ounces for the quarter, and their unit costs would have looked substantially better. The underlying cash generation of selling that gold at high prices is fantastic, but the math of equivalence makes the unit cost metric look superficially weak.
So if you are building a spreadsheet, do not penalize them for gold going up. The project is making great money. The specific metric of cash costs per silver equivalent ounce just looks inflated because of the denominator.
Exactly. Don't get fooled by it.
But wait, if Zgounder is a hyper-efficient machine beating capacity by 45% and Boumediene is generating essentially free cash flow from waste rock, how does net income plummet 28% from Q1 down to $35 million? Gross margins compressed from 71% down to 66%. Where is all this cash bleeding out before it hits the bottom line?
Well, the expense sheet took some very specific, largely non-operational hits this quarter that dragged down that net income number. First, you have taxes. Income tax expense skyrocketed to $21.5 million for the quarter. To put that in perspective, in Q2 of the previous year, it was only $1.8 million.
Wow. That is a staggering jump for a single line item. What drives the tax bill up by $20 million?
It is driven by two structural factors. First, they simply made a lot more taxable income this year compared to last year, so the base is larger.
Right.
Second, and more importantly for your long-term models, there was a statutory increase in the Moroccan corporate tax rate. The government is taking a larger percentage slice of a much larger pie. That is a permanent structural change to their effective tax rate that needs to be updated in valuation models.
And then there is the general and administrative line, the G&A. That spiked 168% sequentially to $7.9 million.
Yeah.
You mentioned earlier that this was heavily driven by professional fees, lawyers, and listing costs. Aya has an ongoing legal dispute with DF regarding their EPC agreements, the engineering, procurement, and construction contracts for their facilities. They are going through appeal proceedings in Spain and arbitration before the International Chamber of Commerce. Plus, they incurred costs related to uplifting to the NASDAQ and getting added to the VanEck GDX ETF. But let me push back hard here. We always hear companies brush off massive G&A spikes as just one-time legal and listing fees or growing pains. But international arbitration with an EPC contractor is notoriously brutal. It can drag on for years, burning millions in legal fees while contractors fight over scope changes and delays. Are we letting management off the hook too easily by just writing off an $8 million quarterly G&A bill as a temporary blip?
It is a very fair challenge. You are right that International Chamber of Commerce arbitration is not a quick or cheap process. Retail investors absolutely should not model this $7.9 million as a pure one-off that drops to zero next quarter.
Right.
There will be an ongoing drag from legal fees until that DF dispute is settled. However, if we connect this to the bigger picture, you have to weigh that cash burn against the company's ability to absorb it. And that requires looking past the income statement to the balance sheet.
Right, because the balance sheet tells a story of aggressive debt reduction.
Exactly the opposite of a company in financial distress. Despite absorbing a $20 million tax hit and an $8 million G&A bill, EIA ended Q2 with $182.8 million in cash.
That's a huge war chest.
And they didn't just hoard that cash defensively. They fully repaid a $15 million project loan from the European Bank for reconstruction and development early. Non-current financial liabilities are down 32% year over year. They are aggressively wiping out debt while simultaneously building a massive cash war chest.
So what does this all mean for the company's internal strategy? The income statement is taking a beating from taxes and lawyers this quarter, but the balance sheet is actually getting stronger with debt being wiped out.
That balance sheet strength is exactly why CEO Benoit Lasalle is completely ignoring the Q2 earnings miss in his public commentary.
Yeah, he didn't even mention it.
No. When you read the management discussion, he doesn't spend a single paragraph agonizing over the inventory lag or the EPS mess. His commentary focuses entirely on Zgonder's record mining rates, the increased operating leverage, and the fact that the company remains firmly on track for its 2026 annual production guidance.
He is managing the physical reality of the mine, not the quarterly accrual snapshot expected by Wall Street.
Exactly. When you have a plant running at 3,900 tons per day against a 2,700-ton design, and you have over $180 million in the bank with declining debt, you don't panic over a delayed shipment of concentrate.
You know it's going to clear eventually.
You know that shipment will inevitably be sold and realized in the next quarter.
Yeah.
Management is deliberately prioritizing balance sheet flexibility and operational execution over stressing about a temporary top-line miss.
Which brings us to the forward-looking outlook for you, the retail investor trying to decide what to do with this stock. We have to weigh the reality of this Q2 earnings miss against the future potential of the company, because the long game I is playing involves massive, aggressive expansion.
Huge expansion.
They have already drilled over 102,000 meters at Boumediene year to date. Just pause on that number for a second. Drilling 102,000 meters in half a year is an incredibly aggressive infill and step-out exploration campaign.
It really shows immense confidence in the geology.
Right. On top of that, they just acquired a new 259 square kilometer exploration portfolio in Morocco for 10 million Moroccan dirhams. They are aggressively expanding their regional footprint while the market is distracted by a quarterly miss.
And institutional money seems to recognize that the operational thesis is fully intact.
Oh, absolutely.
Sell-side analysts have maintained a very constructive view on the stock following the report. Major firms like CIBC and BMO Capital have maintained buy or outperform ratings.
Yeah, they aren't spooked.
They're setting price targets between $35 and $41.50 Canadian, which represents significant upside from current levels. The institutional analysts are looking straight past the inventory lag. They are focusing on the massive cash generation capability of a fully ramped-up Zgonder plant operating at 145% of its design capacity and the future optionality of that Boumediene drill campaign.
They see that the cakes are baked and sitting in the bakery, even if the delivery truck was late. The retail market sold off the stock based on a temporary sales lag and a higher statutory tax bill. But with production costs dropping rapidly, the Zgonder plant running incredibly efficiently, and a cash pile of over $180 million, the real question for you to model is this. Will the delayed revenue from Q2 simply create a massive cash flow slingshot in Q3 when those shipments finally clear customs? Or are these rising G&A and litigation costs a permanent parasite on the bottom line?
It's the critical question.
And frankly, there is an even bigger question hiding in that balance sheet. With $182 million in the bank, debt aggressively wiped out, and a massive drill campaign underway, you have to wonder, is Aya building a fortress balance sheet just to weather litigation storms and fund internal growth, or are they positioning themselves to become a major acquirer in the Moroccan mining space? When a company hoards that much cash while their stock takes a short-term hit, they are usually gearing up for something big. Keep a very close eye on how they deploy that capital in the second half of the year. Make sure you follow the show for daily earnings coverage.